We are back at the Big Money Big Daddy Show. We appreciate everybody joining us today. We are in the home stretch of today's show, so we appreciate everybody tuning in on this Thursday afternoon. If you're just now tuning in, you've missed some pretty good stuff. It was a little downer there, kind of in the middle, so we've kind of what we did was we started on a high, we bring you down, and now we're about to just build you back up and tell you that there is hope to help you achieve that American dream of retirement.
But before we do that, I got a little bit more bad news.
Sorry to mislead y'all. But so I guess let me just recap kind of what we have talked about. You know, we've talked about, you know, a lot of people have this vision of having this nice retirement when they approach that age. And so a lot of people are coming up short because they're not saving enough money and they're not getting good rates of return. So we talked about, you know, the three strategies to help you achieve that. Obviously, you need to invest in equities. You need to outpace inflation, and you need to be invested in a portfolio within a reasonable risk for what you're trying to achieve that will give you those market rates returns. And what we kind of covered kind of towards the end of the last segment was we went over some of the returns of what the markets have actually done over the last 10 years, 20 years, 30 years, going all the way back to 1926 to show that the market actually does produce good rates of returns. However, there is that perception a lot of times, whether it's from the media or other advisors or somebody trying to sell you something, they try to install that fear inside of you to make you feel uneasy about the market. But in reality, you can get good rates of returns. And so we're kind of going to talk about a few more threats that are lingering out there.
Yeah, I mean, and part of the reason that fear works, in my opinion, is because I bet you a lot of the people out there listening have not experienced those 8, 9, 10% rates of return with their investments. But the point that we always try to make is it wasn't because of the market. It was because of the way that you invested in the market, or for most of you, you were being told or advised to invest in the market. And that brings me to 7 deadly mistakes that could really destroy your retirement dreams, because these are the types of things that we see repeated over and over and over again. And it just depends on the time frame that we're in and where we're at with what's going on in the economy. But I mean, it's, you know, if I think, back, 2010 or so and before that, I don't know if people remember, but the, commodities were they were rocking and they were just, booming and booming. And so, I'd see CNBC and MSNBC and all these different shows. They'd have some of these commodities brokers on there, and they'd get on. And I remember one of them was, telling people, this was back in September of 2010, and it was saying to forget stocks and just buy commodities. And, we did go back and actually look from that moment and going all the way through 2015. Had you done that, okay, so this is hypothetical. I'm not saying these are actual results or anything, and I'm not even saying what commodities will do in the future. I'm just merely pointing out the fact, over those next 5 years, your $100,000 would have lost $43,000. And it sounds crazy to say, well, who would do that? Who would put all that money in commodities? Whenever something's on a run, we see this all the time and time again. And we'll go over some examples because you might have done this at some point. Let's be honest about it. Let's admit it. Let's realize, oh man, we went for it. And don't think that this type of stuff can't be sold, whether it's on fear or everybody is getting rich and you're not. I mean, it happens all the time. Gold, that's something we're always hearing about. And, there's Peter Schiff's out there always talking about, buying more gold. Gold hasn't, back in 2011, he was quoted as saying there's no ceiling to the price of gold. The funny thing was, had you taken that advice, and you put $100,000 in there, if we go all the way to December of 2015, you would have lost $32,000. I mean, these are experts on TV talking all the time. They know their stuff. People hear this information and then they move on it. I mean, it just takes someone, that wants, which by the way, don't forget, he's more than happy to take your dollars for gold, even though,
Yeah.
even though the dollar is about to collapse, so you should buy gold, right? And you're going to hear all this. We've got the election coming up, and this stuff's going to repeat. Look, I'm not saying that you can't make money in gold or in commodities. I'm merely saying that it's a total gamble. You're speculating as to something that's bigger than anybody can make a prediction on. I mean, the world is complex. How do you factor in all the variables that go into it? And it's a zero-sum game when you look at those, because someone has to win and someone has to lose. It's not like equities where you're purchasing a living, breathing company that's going to do everything they can to stay in business and make a profit. And yeah, there's ups and downs, but if you understand those and have the right risk, you can get the type of return. But that's a mistake that we see is commodities and the hype that was there, and gold, and everybody remembers the tech boom. Back Time Magazine, the special report back in September of '99 was GetRich.com. Secrets of the New Silicon Valley. Or my favorite, Money Magazine. This was back in March of 2000. It was the hottest market ever. How to invest in it. Tech stocks. And, if I go back to that Money Magazine or Time, so the Time Magazine article came out. If, you got real hype, and so you went out there and the NASDAQ was most of the tech stocks. And if you put 100% of your money in the NASDAQ composite index, you would have proceeded over the next 3 years to lose about 56,000 of your 100,000. The Money Magazine article, they're a little bit better at bad advice.
You always want to be the best.
Yeah, their 100,000. You would have lost 74,000 of your $100,000 in that event. Then there's the fear. Market's crashing or it's about to crash. And, I think one of the best ever is Jim Cramer when he got on this was October of 2008 and advocated everybody should just sell their stocks. Who cares about what you've lost? It doesn't matter because it's only going to get worse from here. And had you taken that advice, which, mind you, a lot of people did, and that's the sad truth, at that point in time, from October of 2008 to December of 2015, you would have if you had 100,000, you would have given up 105,000 extra. So that's 205 is what it would have been. I mean, extra, and that's just amazing. It's amazing that we so easily make these mistakes, and I think a lot of that's because of the emotions that we have about investing. And one of the things that we've always been advocating is decide today what risks you should take, so that when these things do happen and it does get scary and we are nervous, you already have a plan in place of when to buy and when to sell. And, that's something, if you want us to take a look at your portfolio and tell you the exact risk you're taking by using our portfolio MRI software, just send us an email. We'll set up a time. We'll look at your statement. We'll tell you our thoughts. We'll tell you the risk. We'll show you the returns, and, let you know if you're getting the rates of return that are out there. You probably already know if you're probably not doing good and you don't understand why, and you hear the markets are up and your account might be down or it's not making anything. I mean, let's just take a look. We'll give you our professional opinion. You just need to email us at BMBD for Big Money Big Daddy at wealthdesigngroup.net. That's BMBD at wealthdesigngroup.net. You can just give us a call, 713-826-0426. And if you want to stay in touch, just text the keyword daddy to 72727. So back to the mistakes that we've seen in the past, and they will come again. Another one that was my favorite was Bogle, who's the founder of Vanguard, which, of course, think of the Vanguard S&P 500 index fund, which, understand where people are coming from in when they give this advice. But his quote was, I wouldn't invest outside the U.S. If someone wants to invest 20% or less, that's fine, but I wouldn't do it. But if you want to, that's fine. Really? When I look at that so that in 2000 to 2015, the S&P 500, remember, you can go out and buy the S&P 500 super cheap. There's probably nothing cheaper than that out there. Its returns were 89%. Now, if I look at some other indexes, and I'm looking at the dimensional funds indexes, the international large value, 137% compared to 89%. Emerging markets, 211% compared to 89%. That's total return over the period of time. What about international small companies? 240%. Emerging markets that are small, 354%. Really? We shouldn't invest globally? You don't think, number one, that just gives, even if you ended up in the same place, but you had more diversification, I'd make the argument I'd do that.
Right.
But you're actually adding returns historically. Of course, I don't know what the future will be. I can't predict that. I'm not trying to. Just giving you the facts of what has transpired. So, what about real estate? People love real estate. It's tough to get in a battle about real estate. But here's the reality. Number one, I think that if you have real estate, it should be localized real estate that you can be there, you can check on. You already own a bunch of real estate in your home, but when it comes to your portfolio, if I look at REITs, which is really real estate inside of a mutual fund, and I look at the Dow Jones U.S. Select REIT Index, if we go back to 2007 and Bernanke talking about how the real estate market's stabilized, everything's fine. They're $100,000. You would have lost $70,000 in the REIT index. Okay. That's, when we look at that, that's why we don't put that type of stuff in a portfolio, because the reality is it's volatile. REITs are volatile. Now, don't confuse that with your individual experience in real estate. That's very different than when we talk about real estate inside of a portfolio on these larger scales. But to us, we look at it and be like, why would you do that when you could just add value or small companies, same risk and way more return when you look at it historical. So those are the types of things. Look, you've got to take a long-term view. And when people don't, they make huge mistakes. When you look at 1 year time frames, okay, and everybody out there, if I ask you, are you investing for the long term? I think everybody out there would say, yeah, I'm investing for the long term. But I kid you not, how many people after 1 year start to fret if they should make a change to their portfolio? And when you look at the returns, it could, in 1 year, when I look at a growth portfolio, looking at like the S&P 500 index and the Barclays index, it could be anywhere from -40 to +60. But when you hold it for 5 years, you bring your low end down to -18% to as much as +40. 10 years, you can almost eliminate, nothing's guaranteed, but I'm just talking historically, you can almost eliminate negative returns. And I even told you if you were 65 and you were married and you were retiring today, 27 years was the life expectancy. So you still can invest long term. If I look at 20 years, you can't even, with a properly diversified portfolio, you can't even find where there's negative returns. Now, I get it. There's a lot of money managers who are market timing and making all those mistakes. And, to me, it's, yes, the returns can be negative, but if you're doing it the right way, using math and science and evidence-based investing, you'll get where you want to get. So that brings us to our hard truth minute that only a good Big Daddy would tell you. Listen, do you want an abundant retirement? Well, then don't depend on company pensions or Social Security. Get out there and create a financial plan and have an advisor. Do you even know if you're getting enough return to meet your goals? Do you know what you're even getting? You need to know that information. Look, you need to own equities. You need to outpace inflation. You need to own equities in the right amount for your risk level. Do you want to just gamble and speculate with your retirement and get caught in the traps of commodities and gold and market timing and tech stocks? None of that stuff works. You need to focus and have a prudent, globally diversified, low-cost portfolio.
So we talked about mistakes this segment. So, obviously I would say the bonus mistake we'll throw in there is, number one, just make sure you're working with a financial coach. A lot of times you get caught up with someone's that's just trying to push some type of product. But Mark and I believe, our firm believes very heavily.
I think things are heavenly.
It is heavenly, right? But we believe that you need to sit down with a financial coach that's going to look at the big picture, that's going to do the analytics on the portfolio. You talked about the MRI earlier. So make sure that you're doing those things. If you want to get in touch with us and have us do that analysis on your portfolio, you can contact us. You can email us. We also want you to come to our monthly coaching that we have each and every month, which next month we are doing that on October 20th. That's going to be at Papado's, and we'll be talking about, is your money manager a sociopath? So we'll be having some fun at Halloween time to go over those things and once again just help you understand, is what your money manager doing, is it the right thing? Not only is it the right thing in general, but is it the right thing for you as an individual? So text the word daddy to 72727. Text the word daddy to 72727. We'll get you registered for that event. You can also call us at 713-826-0426.
Yeah, we'd love to meet you. Come to the event. Big money, big daddy.
I've had enough of scheming and messing around with jerks. My car is parked outside, I'm afraid it doesn't work. I'm looking for a partner, someone who gets things fixed. Ask yourself this question, do you want to be rich? I've got the brains, you've got the looks. Let's make lots of money. You've got the brawn, I've got the brain. Let's make lots of money.
Hypothetical examples discussed are not intended to suggest a course of action or represent the performance of any product or security. All investments contain risk and may lose value. Past performance is not a guarantee of future results. Diversification does not guarantee profit or protect against market loss. Investing in foreign securities may involve heightened risk, including currency fluctuations, less liquid trading markets, greater price volatility, political and economic instability, less publicly available information, and changes in tax or currency laws. Such risk may be enhanced in the emerging markets. The S&P 500 index is generally considered representative of the stock market as a whole. It, however, focuses on the large cap segment of the U.S. market. Indexes are unmanaged and you cannot invest directly in an index. Wealth Design Group does not give tax or legal advice. Anything mentioned in the show related to these items is not advice, and you must check with your CPA or attorney prior to taking action. Securities products and advisory services